Hi, everyone. This is the One Point Podcast. I'm Rohit Yadav. We recently released a comprehensive ecosystem-wide report called as Rethinking Venture Capital from a Strategic Lens. In that, I use the concept of Venture 3.0 in a much broader and deeper context of system-level changes to the entire value chain. Now, this term, Venture 3.0, is not new. And the very early users of this term focused on actually a very narrow sleeve of the advent of AI within the VC business. So today we are here to capture and cover just this specific topic, all about the use of algorithms in the venture business and the investments and AI VCs. And to do this, we have the perfect person with us, Rob from SignalRank. Rob, thanks for joining in.
Oh, thanks for having me, Rohit. Delighted to be here, and congrats on your report. It's a phenomenal read, and it must have been a huge amount of work.
Thank you so much for the kind words. So let me introduce Rob to everyone. Rob is the managing director of SignalRank and leading the investments function there. He is a tech investor for the last 15 plus years. Previously, he was a CEO of a venture-backed online video platform, which was acquired in 2019. And prior to SignalRank, Rob was focusing on Series B plus SPV. So he has a lot of experience within this space of Series B, what comes after seed and so on. And it was backed by leading US family offices, specifically in the SaaS and the consumer subscription software business, which are actually pretty famous back then, right? So, Rob, I hand it over to you. So, what actually is SignalRank?
Yeah, so SignalRank is a index of the top 5% of Series Bs, where we have a systematic way of identifying the top 5% of Series Bs, and then we access those Series Bs through the pro-rata of existing seed investors. So ultimately, what we are building is the equivalent of your S&P 500, but for venture capital. So we are very much playing within this theme of democratization of access and using data to invest into venture capital.
Okay. And so tell us more about the background of SignalRank. Where did the idea come from of using algorithms in deciding the investment process?
Yeah, no, I was a VC in London 10, 15 years ago, and it always confused me that VCs believe that data is going to transform every industry in the world except their own. And if I remember, we were looking to hire a data scientist about 10 years ago, and at that point, the data probably wasn't good enough to be able to execute a kind of data-led strategy. And so as you said, I left to join a video startup. We sold that in 2019. And for that startup, which was in Europe, it took me a year to raise the Series B, being a kind of European based company where the capital is kind of thinner than elsewhere. So we sold that in 2019, and then I moved to the States in 2020. My idea originally was to try and solve that kind of Series B problem for European companies with US capital. Okay. And so I went to a couple of fairly well-known seed investors in Europe and say, look, I know that you're tapped out at Series B and you don't have enough capital to continue to defend your position at Series B. So I will spin up an SPV, I'll find some US family offices, and we'll invest in these great companies, and then we'll split the carry. And by doing that, you're also bringing kind of US investors onto the cap table of these European companies. So it should be easier for them to raise money from US investors going forward. So that model works quite well, but it wasn't very scalable. And in 2020, I was introduced through a mutual friend to Keith Tier, who's happens to be another Brit in the Bay Area. Keith is kind of a legend in technology circles. Co-founded Europe's first internet service provider. That was his first unicorn, and then he created a second unicorn named Real Names from the Valley. He then co-founded TechCrunch in 2005. Most recently, he'd also been the chairman of a VC fund where they'd played around with this idea of kind of supplying pro-rata capital to seed investors. And he had built this kind of data-led strategy for identifying the top 5% of Series Bs. And so I joined Keith and the rest of the team in 2020, kind of gone from there, where the idea is to use data to identify the top 5% of Series Bs. And the way we do that is fairly unusual in that there are lots of other data-driven VCs out there, which I'm sure we'll come on to. But we exclusively look at investor patterns and signals. And so we actually don't look at the kind of fundamentals of individual companies. And that's because we believe that there is persistence in venture capital. And if you're an investor and you get access to a good high quality company, and then it's very likely that subsequent deal flow will be high quality too. And plenty of people's track records and reputations are built kind of on that idea. And so all we are doing is kind of codifying that knowledge, where we basically we investors at every stage, so at C, Series A, Series B, Series C, etc. And we do that by looking at, over a rolling kind of 3-year window, we look at every stage, how many unicorns have you invested in? What's your unicorn efficiency, which is kind of your hit rate? So if you make 100 investments, how many go on to become a unicorn? And then what is your MOIC for every single investment at that stage? So that generates a ranking. And then we start to look for patterns across those rounds. So, what happens when a top 100 seed investor invest in the seed round and then the A round. And then there are tremendous signals when world-class investors re-up from the seed to the A. And then we will also look at who's participating in the Series B, such that we've transformed the probability of identifying a company that can deliver X MOIC from Series B to about 30%. And the market average is 10%. So using some fairly basic heuristics, we can increase the probability of success by about 3x.
Got it. And so because we are on this topic, let me ask a couple of more questions within your investment process. So if I understand correctly, you're focusing entirely 100%, correct me about this percentage figure, investor data, not individual company data, even though actually you would have more data at the Series B level rather than seed level. The companies are very new in the very early stages, pre-seed and seed. They wouldn't have such a solid data to produce. And so when they progress through the layers of investment, you are still looking at the investor data, because the thesis becomes, hey, you know what? The investor who has done investment, there's reputation on the line and so on. They will continue to get the good deals. So there is this kind of deal magnet effect, right? And second, because they are doing those deals, those will continue to generate top tier returns. So is my understanding correct around this?
Yeah, that's right. We're effectively kind of standing on the shoulders of giants in terms of looking at kind of social signals from those investors across multiple rounds. So by the time it gets to the Series B, there's enough signal from those multiple rounds to come up with what we call a company score, where that company score has high predictive power as to how that company is going to perform. So what we're doing is unusual in venture, but it's not actually unusual in finance. So the world's first hedge fund, set up by Alfred Winslow Jones, was actually using a fairly similar technique, in that he actually didn't come from a finance background, and he essentially outsourced investment ideas to brokers, and he would basically score the brokers for the performance of their recommendations, and then weight that to decide exactly what he invested in. So that was the world's first hedge fund. And then actually Europe's biggest hedge fund today is Marshall Wace. And about half of their AUM is through something called the TOPS program, where they have a very similar approach, where they are effectively ranking sell-side broker recommendations. So for example, if Goldman said 3 years ago, you should buy NVIDIA, you're going to give more weight to their recommendations today than someone else who'd recommended something different. And so we're essentially applying the same logic to venture capital, but we're not looking at broker recommendations. We're looking at the track record of those VCs historically, because the academic papers demonstrate that there is persistence in venture, and that once you get that network centrality and have that high quality of deal flow, you're more than likely to continue to get access to high quality opportunities.
Okay. I will ask you a debatable question. So you totally agree to the PitchBook's recent research on network effects and its importance, right? Because there is another side to this topic. There are some VCs who do not ascribe to this thought process that network should be important, or network should be as much important within the venture space because of various reasons, right? So what's your take on that?
Yeah, I think actually the most interesting stat from that PitchBook report was the success rate and the failure rate of highly networked investors, and the well-networked investors uh, uh, support their companies on the upside, but also the failure rate is just substantially lower.
Got it.
And so that's kind of what we are. That's kind of how our algorithm works. In that um, our algorithm is actually a negative algorithm. In that when we select a company, we are not saying this is going to be the next Databricks or this is going to be the next Uber.
Yep.
Our algorithm is very good at identifying zeros, and so we eliminate all the zeros, and that leaves a pool of assets where the probability of success is much higher. And then we are randomly sampling within that pool of assets. And when you Monte Carlo simulate that portfolio, it outperforms the average in venture very substantially.
Okay.
So that the back test of that model is kind of 5x MOIC in 5 years.
Okay. So I'm curious now. So why just Series B? First, this question. And then the point comes of location, right? I'm pretty sure you're not just focused on the US, but other geographies as well. So how does geography plays a role within the algorithm with respect to data, obviously? And then why just Series B? Why not go like one step ahead as well?
Yeah, I mean, our model and our approach actually works at every single stage, but we like Series Bs for 4 reasons. One, you can deliver a kind of risk-adjusted portfolio without making a huge number of investments. So the signal is sufficient that by making 30 investments a year, you can approximate that kind of pool of assets. And so we like the fact that we can use data. Secondly, the risk return profile is pretty compelling. So the power law is still kind of in its infancy at Series B. So you can still get these 25, 50, 100x returns from Series B. Okay. Thirdly, you are well insulated from post-IPO risk. So by the time most companies are IPOing, they've raised subsequent rounds beyond the Series B, such that even if the IPO performs badly, you should still make money as a Series B investor. So if you look at something like Instacart, I think the last round to actually make money, the IPO, was Series B. And then lastly, Series B is a perfect entry point for our strategy of supporting seed investors to finance their pro rata, because by the time the Series B comes along, most investors have run out of capital to continue supporting their portfolio companies. Okay. And so it's just a very natural entry point to help seed investors. And we now have a network of about 300 seed partners who are sharing deal flow with us, such that we're seeing about 100 Series B term sheets a month.
Wow, awesome. And so, with respect to location,
in terms of location, we're a proper index in that we are geography, manager, sector agnostic. And so our whole program is about reducing adverse selection, such that we want to make sure that we're seeing effectively all Series Bs globally. And then we rely on the algorithm to identify the top 5%. So, like any other investor or any other VC, we spend most of our time saying no to people, just because the algorithm didn't like the company or the company score. And it's worth saying that when we say no to people, it's not that's not a reflection of the company. It's just we're looking for certain patterns and signals that company might not have. So our model is very high precision and low recall. So when we make a decision, the hit rate is pretty good, but we do miss a lot of unicorns or power law winners.
Okay, so I want to capture the last point. So you do use some companies. Yeah. How much of the Series B market do you actually see? If you want to disclose this, like, for example, there's 100% of deals happening within 24. What percentage of those deals do you see because of the seed network that you have already built?
Yeah, as of today, we think we're seeing about 60% of all Series Bs come across our desk. Okay. Through that network of about 300 managers. So, we still got some work to do, but in relatively short period of time, we are seeing a good proportion of the Series B market. And then maybe more interestingly is like how many what percentage of all of the qualifying Series Bs that we want to invest in are we seeing? So if there are roughly 1,500 Series Bs a year,
Okay.
there are about 100 or so Series Bs that will qualify each year for our product. And at the moment, we're seeing about 25 to 30% of those Series Bs. So we've still got a lot of work to do in terms of like increasing um, our exposure to that full kind of qualifier universe. We think, but bear in mind, we've only been investing for 2 years and we've already made 35 investments. So apart from Andreessen Horowitz, we're the most active Series B investor globally by number of investments.
So congrats on that. Really.
Well, yeah, thanks. I mean, so we feel like the access point we've kind of definitively proved out. I think that there was another question when we launched about, well, how do you reduce adverse selection? How do you make sure that you're not just saying, the deals that no one else wants to finance? And again, I think we feel like the quality of the deal flow we're seeing today is such that we've kind of definitively kind of proven that out. I mean, just to give you a flavor for that, I mean, in 2025, we've already invested in 5 kind of Sequoia-backed Series Bs. And in terms of like the kind of top 3 or 4 co-investors with us at Series B, it is Andreessen, Sequoia, YC, and Lightspeed.
Awesome. Now, I looked at your data regarding the SignalRank Index, the article you recently published of investing 2 years in. Do you have some more insightful, let's say, pointers to share from that index? And given that you do not see the whole market, but you still call this an index, is that because nobody else invests so much as you do in that segment? That's why you call this index? Or, for example, do you call this an index because that's the only way, let's say, people can get access to that layer of investments? Because not everybody can invest in A16Z or Sequoia, for example, but probably people can invest in SignalRank.
It's the latter, really. It is true that it is, in the strictest sense of the word, it is not an index, and that is not 100% of the qualifiers that we see. We are sampling within that index. But in terms of like communicating to investors, index is kind of the best word we have for kind of reflecting what we're doing. Because as you say, I think the reason SignalRank exists from the investor's perspective is that in venture capital, everyone knows that the returns are all kind of power law skewed, but the median returns are pretty poor, and so you have to be investing with the best investors. But you cannot become an investor in Sequoia or Andreessen directly unless you have a large amount of money, and you were probably in Silicon Valley a long time ago, because there's so many times oversubscribed. And so what we've built is a product where you can mimic or mirror their portfolio without being an LP, because we are co-investing alongside them in these high quality Series B. So as you said, our idea is that ultimately we're looking to list this as a public index such that you buy a share into SignalRank and then you get immediate exposure into a portfolio. And by the way, you also get that historic vintage exposure. So I actually think the strongest reason for investing into SignalRank is not only we expect the returns to be compelling, but it's that you get this kind of vintage diversification. So if you invest in any traditional 2 and 20 fund, you are taking vintage risk that vintage of even with the best managers in the world, right? You're taking vintage risk unless you're investing in every single fund. You're betting that vintage is going to be the one that delivers kind of top decile or top quartile returns. Yep. With our model, because it's kind of one structure across multiple vintages, you're getting that diversification just by buying one share.
Yep. Never time the venture market, right?
Yeah, there you go. Yeah.
Okay. So Rob, I want to understand from a seed investor perspective. So you have this network of 200 plus seed investors across geographies. What makes you interesting as a partner for them?
Yeah, it's a good question. There are essentially 2 reasons why people partner with us. One is we offer 20% deal by deal carry.
Okay.
So if we invest $1 million into a company and that company 10x's, we get our $1 million back. There's $9 million of profit. We will write you a check for $1.8 million. So very compelling economic reasons. And then secondly, we can move very quickly. So we can actually finance these companies and close within a week, because the diligence we're doing is around the cap table, the Series B term sheet. We do look at the financials, because the biggest mistake we could make is invest in a bridge round that's disguised as a Series B. And then we will spin up the SPV in your partner's name and finance in with that kind of 80-20 split. So we found that, effectively we're offering a free option to our seed partners. And it's a pretty compelling model in a low friction way that allows them to continue to participate in their winners. Because if you think about who most seed investors are, most seed managers, I'd say 99% of seed investors do not have an opportunity fund. And that's because most seed investors are ex-operators ex-entrepreneurs who want to kind of give back to the ecosystem and continue to invest in the next generation. On average, they're managing about $50 million. And so by the time it gets to Series B, everyone's just tapped out. And so we offer kind of a free option to allow them to continue to participate at Series B.
Okay, so by opportunity, follow-on funding, right? So okay,
yeah.
So seed investors are restricted around the seed stage. They might have, let's say, 15-20% to expand into A, but then they kind of tap out with the capital to go till the Series B, right?
Yeah, that's right. That's exactly right, and that's kind of how we help them.
Okay. And so one interesting question comes in, like, if the area is so interesting, why aren't there more AI VCs like SignalRank?
Well, on the pro-rata side, there are 4 or 5 other groups that do a good job in this space. So, folks like Alpha Partners, Proof, the two that come to mind. And so I think, more and more people are seeing that pro-rata is actually a really interesting access point into high quality Series B, or high quality companies, Series B and beyond. In terms of AI, I think it's a great question. I mean, there has been a drive recently to more kind of data-led or AI integrated workflow, and I think that will allow kind of greater leverage of existing teams, whether it's sourcing or diligence or even kind of portfolio management. I think where we are still unique is that we actually rely exclusively on the algorithm for investment decision making. And that leads to some quite interesting conversations internally where, certain individuals or collectively, our collective individual experience is kind of not really relevant or taken into account into the decision-making process, because we rely and believe in the algorithm. And so that is the decision-making tool. Because if we don't believe in it, then why would we ask our investors to believe in that model either?
Got it. It's a perfect segue into the next question, which is zooming out for AI in the venture business. You are specifically focused on the investment part, and that to doing the due diligence, not even due diligence, I would say, like kind of understanding where to invest, right? So it's a combination of sourcing versus as well as due diligence. There are other aspects, as you mentioned, in terms of just startup discovery, which could be applied actually pretty effectively. So typically investors might need help with startup discovery. And then there are tools in the portfolio management phase, which are using some sort of automation, AI and XYZ to channelize the processes into more robust and more free-flowing processes. So where do you think, except for your own model, where do you think is the next biggest opportunity in the next 2 years or 1 year of using AI within the whole model?
It's a good question. It's a big question. I mean, if I step back more broadly, my own view is that the earlier stage is an artisanal, hand-to-hand combat business that is very unlikely to be kind of data led or data enabled. I think if you think about what the best seed investors are very good at, it is reading people, and that is unlikely to change, or it's unlikely that data is going to play a huge role there in helping people talent spot better or worse. So I do think that at that earlier stage is going to remain artisanal. At the later stage, I think that starts to look more and more like the public markets. So, we are building an index, a systematic index of passive investments at Series B. Mm-hmm. Index investing in the public markets has been around for 60 years and is now, more than 50% of AUM, because, no individual active manager can actually beat the index over time. And so we expect a similar kind of narrative to play out in the private markets, where just in the public markets, where the best active managers can charge actually higher fees than carry. So can you get to Renaissance Technology with their medallion fund at 5 and 44? Mm-hmm. Why if you consistently deliver alpha to your LPs, why can't Sequoia, Andreessen, and others start to move beyond that 2 and 20 model and start to charge more? So I expect some of that to happen. Okay. And then for everyone else, I think a kind of passive index fund, just as in the public markets, would be a superior product. So that's kind of where we think this market evolves to.
Okay. And if you talk specifically about usage of AI, do you see individual use cases like just for startup discovery or for portfolio management or for analytics of performance and so on? Do you see these models growing up, or do you see like there might be a player which then needs to build all those different functionalities into one single tool and then give it to the VC industry? Like, where do you stand with respect to that?
I think different VC firms are trying different things with the application of AI, whether it is like, buy or build. I think that ultimately, what is the core product? Ultimately, it's the decision-making engine. I think Mike Maples talks about this, that really when an LP is buying into a fund, it's that investment, it's that decision-making engine. And so to the extent that AI and data can improve or support that decision-making engine, then I think you'll see more and more investing in AI. If it doesn't do that, then it's somewhat incidental to the kind of investing process. I think there are a number of groups that are really pushing the envelope here. And I think it's pretty exciting to see, even the last 3 or 4 years, the development across kind of automating workflows. So, Andre Retoreth, his kind of data-driven VC group in particular, he's done a phenomenal job in building a community of people who are interested in this space, and so that everyone can actually kind of learn from each other and agree what is kind of best practice.
Awesome. And so, last question on this topic: like, should traditional VCs be fearful of AI and venture business as of today?
I don't think so. I mean, you probably saw Mark Andreessen say recently that he thought being a VC was probably one of the last professions that could get automated by AI. I mean, as I said, I think it really depends. I mean, and as your report says, like, there is no monolithic venture capital industry anymore. It's become a lot more interesting in my view, because you're getting product stratification, you're getting risk return stratification, so that particular investors can decide exactly where they want to play on the field. So I don't think there's one answer for the whole industry. I mean, as I said, I think at the earlier stages, my expectation is that AI and data tools play a kind of a minimal role relative to that later stage. Having said that, I think you'll get to a point quite soon where if you're not investing in AI tools, then you'll be getting left behind.
Okay. I want to switch to the personal side for for the second last question, and then we kind of zoom out again. So what has been your experience in your journey on an emotional side? Things obviously in the venture space are not linear. There has been ups and downs, probably in your case as well, as somebody who's leading the investment function. So how has your journey been on Single Rank?
Yeah, I'd say that on the investing side, we've very much seen the thesis play out.
Okay.
And I think obviously the ecosystem has changed a lot since 2021. Um, and we've actually built systems and a thresholding mechanisms to allow us to react with the market. So when the market's very hot, we will invest less, and when it cools down a bit, the threshold will go down, so we're easier to access our capital.
Okay.
Such that if, as and when 2021 happens again, then uh, uh, we should be affected less because it'll be harder and harder to access our capital. So all of that to say that the market dynamics of things cooling down in 2022 and 2023. I mean, obviously we would like to see great companies continue to attract capital, but it doesn't really affect our investing mentality that much because we've already built in mechanisms to allow for being greedy when people are fearful and being kind of risk off when people are greedy. So that's on the investment side. On the fundraising side, I think that that's it's been a harder route than we would have thought because we are trying to do something different, and we totally get that pushing the boundaries in terms of innovation at a time when venture is not flavor of the month. It's been harder than we probably expected 3 or 4 years ago.
Okay.
But I think there is, in my view, there's an inevitability around what we're doing. And so then the only question is this going to take 1 year or 10 years to get to scale? And so the idea of kind of indexing and democratizing access to venture capital is inevitable. And what we've seen in the last year or so is that actually the financial industry, the tailwinds towards this democratization have only accelerated. So, if you look at what BlackRock is doing, if you read Larry Fink's latest his annual letter, if you look at his acquisition of Preqin, you look at where Stepstone are going, where Coty are going, and the whole market is moving towards this kind of democratization of access and pulling in kind of retail investors into venture. And we feel that we are at the moment playing a small part in that journey, and we want to play an ever increasing role in the ecosystem.
Okay. So a perfect segue to the last question, like what's next for Signal Rank then? Where do you envision yourself in the company next 2 years, 3 years down the line?
Yeah, I think we want to continue to deploy at pace. So we are deploying at the pace we want to. Two or three Series Bs a month. Our challenge is increasing the capital we have under management, such that on average the allocations we're seeing are about $5 million per Series B, and we're writing checks that are lower than that today. And so our focus is continuing to support our seed managers, continuing to build that network and strengthen those relationships, and at the same time raising more money to allow those seed managers to benefit from this kind of pro-rata as a service product. And then ultimately, our intention is to list SignalRank at some point in the future. That's kind of the ultimate goal. We can actually allow MOIC to be converted into DPI at any time. So if you're an investor and you want to get 100% liquid, you can just sell your share into SignalRank.
Awesome. With that thought, Rob, thank you so much for joining in. It was an amazing conversation and I loved what you're doing. I'm like wholeheartedly, I feel really that this is, I'm not saying the whole industry will go this direction, but definitely like there is a very big space for you guys and others obviously who is in this space, and it's inevitable. So it will happen definitely and for sure. So fingers crossed for you for what you guys are doing at Signal Rank. And thank you so much for joining in.
Well, thanks, Rohit. This has been great.
Thanks.
Appreciate it. Bye.
So